Velkommen til Rig på Viden, en podcast om forskning i investering, finans og økonomi. Mit navn er André Thormann.
In this episode, we are talking to Markus Ibert from CBS about equity return expectations and portfolios from large asset managers. Hey Markus.
Hey.
Thanks for letting me come by CBS today. For those who don't know you, can you maybe start by introducing yourself?
Hey, Andre. It's great to be here. Pleasure. Thanks for inviting me. So my name is Markus Ibert, and I'm an assistant professor here at Copenhagen Business School, and I have been since 2022. Before that, I worked 4 years at the Federal Reserve in Washington D.C. as an economist in the International Finance Division. And my background in education is that I have a PhD in finance from the Stockholm School of Economics that I completed in 2018. And now mostly I at CBS I teach and I do research, and my research is generally in the area of asset pricing and asset management. Yeah.
What did you do in Federal Reserve?
They have lots of economists there.
Yeah.
I was one of those economists, and like I said, I was working in the International Finance Division in particular. So there's several divisions at the Federal Reserve and several research-focused divisions, and one of them is International Finance. And I was working in a section called Global Capital Markets, and the idea of that section was to monitor financial market movements across the world in equities, in corporate bonds, to some extent sovereign bonds and FX. And to explain why markets move and what they're telling us about, say, the growth outlook, and to explain basically market movements to our principles, and then to develop models and products that can help extract something useful from asset prices for the principals, in particular the board. Yeah.
Okay. How is it that, like, I mean, I only know Fed from media, kind of, right?
Yeah.
And it's like some very special things for people, I guess, in Denmark. Especially if you're a little bit interested in economy. What's the atmosphere like working in the Fed?
I think it's a great job. It's a great atmosphere. I think it's. I would think of to most people, I think they think of the Fed as setting an interest rate, and that's the one thing they do. But I think they do much more. I think they have like 500 economists in DC, and then of course you have all the reserve banks, and they also have their own economists. And I would think of it as a kraken, right? So as a kraken, if you have ever heard of some financial product or market, it will be covered by some economist at the Fed, and they will be an expert on it. And most of the time, maybe nothing will happen in that particular segment of a financial market. But when something happens, then that one person comes out and is an expert and can brief the governors. So they do much more than just setting the interest rate. They care about, in particular in the division that I was working in, they care about spillovers from the US to the rest of the world in terms of how does monetary policy spill over from the US to the rest of the world. But they also care about spillovers from the rest of the world to the US. What happens if there's a financial crisis in Europe? How does that spill over to the US? How does a banking crisis in Europe spill over to the US? At that point in time, they also cared about, maybe they don't care so much about it anymore, about climate change. How does climate change affect financial stability or monetary policy in general? Yeah.
Okay, interesting. That we could talk much more about. I'm sure.
I'm happy to do it.
What has been like the key focus from you research wise since you started in CBS?
Since I started at CBS, so I think I did my dissertation in Sweden, mostly working with the mutual fund data in particular on Swedish mutual funds, because I have some great data on Sweden on how these mutual fund managers are paid. So you can get access to the labor income, and you can check whether they're paid for performance, and you can also see what they do. Sweden used to have a wealth tax. You can see in the administrative records what they actually not only do in their mutual funds, but also what they do in their personal portfolios, like trading in their personal accounts. So I mostly focused my dissertation on that because it was some great data. Since I started working at the Federal Reserve and then here at CBS, I've switched a little bit of focus, and I would say my recent research since I've started at CBS is mostly on return expectations, equity, fixed income of institutional investors. Like, think of the largest asset managers, think of BlackRock, JP Morgan, Vanguard, but also pension funds. Yeah. So I would say, return expectations of institutional investors. That's my focus since I've been at CBS. Yeah.
And why is that so interesting?
So I think it's interesting because, so first of all, what we would call this in academia is research on subjective subjective expectations, as opposed to, say, objective expectations. The difference being that, subjective expectations are when you ask people, what do you think will be the equity return over the next 10 years, as opposed to having a statistical model that spits you out, valuation ratios are high, so objectively, according to this statistical model, it could be regression, it could be much more complicated, the return over the next 10 years will be low. So those are the two differences. You can either ask somebody, and maybe they'll have a model themselves in mind, but still you ask them, or you can have your own statistical model where you run a regression or machine learning or whatever to give you a return expectation. So I focus much more on the subjective part. And I think that's interesting. I think it's interesting because in general, focusing on expectations is interesting because you can think of realized returns being very, very noisy, but realized returns can be written as an expected part plus noise, right? It's just by definition. And I always thought that due to the noise in realized returns, it's very difficult to say something statistically about, there's this famous example where you don't know whether the equity premium is 8% or 2%, even with 100 years of data, because it's just financial markets are so noisy. And by definition, expected returns are less noisy, right? So I always thought that you can learn something interesting about something less noisy. And I think that's one reason that these subjective expectations are interesting. The important thing I always thought is that once you focus on expectation and you think of realized returns, it's expected returns plus noise, you really want to focus on those expectations that actually set prices and not just some like random expectations of some random people. And that's why I think it's particularly interesting to look at, the expectations of the largest investors that probably set prices to some extent.
Yeah, that makes sense. And you have been researching into this, and we're going to talk much more specifically about your paper. But just to establish like a fundamental understanding, what do we know from research about how expectations are formed for equity returns?
Yeah, so I think you have to distinguish between these institutional investors that I focused on, and you have to distinguish between those and also like retail investors, people on the street. So I think they will have very different ways of how they will form their return expectations. So I would say, what do we know? Let me go back a little bit in time and elaborate on how this line of research has developed in academia. So I think in the maybe 1980s, 70s, the people started to realize that stock returns might be predictable, actually. So that's how we think about stock returns nowadays. We think they're predictable, at least in the long run. So basically,
it's not a random walk.
It's not a random walk, no. So you think that, particularly, if the price dividend ratio or the price earnings ratio, like a valuation ratio, if that is high, it's generally a consensus that will predict lower returns in the future. And similarly, if a valuation ratio is low, the consensus is that it will predict higher returns in the future. And of course, that's very noisy and it doesn't hold with certainty. And the last 10 years have been an exception to that. But I think that's generally the consensus in academia. And then people have started writing models that try to rationalize these facts, right? They try to, this fact would call it a counter-cyclical equity risk premium. Counter-cyclical, why? Because, in the recession, this risk premium will be high. and in expansion it will be low. That's why we call it countercyclical.
So the easy way to understand that this is, if something is very expensive, you can kind of expect a lower return.
Yeah.
But if it's very cheap, you can expect a higher return.
Yeah, that's pretty much it. Yeah, that's pretty much it.
That's the non-academic way.
That's what we call countercyclical. But that's exactly it. Exactly. Yeah. And people started writing models. They started writing models to rationalize that, right? So you have something like, say, a Campbell-Cochrane habit formation model, a famous model. It will generate these countercyclical equity premia. But all these models, they're rational expectations models, right? So then in these models, the agents, they understand how the world works. They understand the law of motion for equity prices. They know everything. They know all the parameters. And they will agree. They will say that, well, in a recession, I will expect high returns because prices are low. And in an expansion, I will expect low returns because prices are high. So that's the rational expectations world, right? And then at some point, people started asking, well, let's just ask people. Let's ask people, are people rational in that sense? Let's ask people on the street, Andre, do you expect high returns in a recession and low returns in an expansion? And I don't know about your personal experience, but in general, what people would answer is the opposite. They would have extrapolative expectations. They would say, well, in a recession, I think it's going to be low returns. It's bad. It's going to be bad in the future as well. And in expansion, when valuation ratios are high, they think it's going to be continue to be high returns, and it's continuing to be going too well. So they're not acting countercyclical in that sense. And then you have all these different surveys, and to some extent also CFOs and some little bit more sophisticated investors. You never saw these return expectations that are countercyclical, that are implied by these standard asset pricing models. And that led to a huge, flow of research in what we now call, I would say, behavioral finance, right? So then people started to think, how can we have asset pricing models that incorporate those extrapolative expectations, and to what extent can these extrapolative expectations, to what extent can they help explain, say, asset price bubbles? So that is what we know, I think, about the return expectations of retail investors. But at some point, there was so much evidence of retail investors that we, in particular me and my co-author Magnus Dahlqvist and me, we thought about how does it look like for institutional investors? And not everybody has these extrapolative return expectations. How does it look for like really sophisticated investors? And that's what we focused our research on, and we found that those investors, they, in contrast to the retail investors, those investors, they actually, in general, seem to have much more rational return expectations that are aligned with standard models and what we teach our finance students here at CBS, basically. Yeah.
Interesting. And is it possible, before we talk about your paper, but just in general, for example, if we take the retail investors, to distinguish between return and risk-adjusted return? Because I guess if you're in the middle of a recession, the reason you might say, I don't expect much return, is because you're afraid of the risk, I guess. I mean,
yeah. So I guess that would be a question about the framing of the survey in question.
Something like that, right? But because if everything continues to go up and up, you say, I expect some return with a very low risk of it's not coming or whatever, right?
Yeah.
And if you are in a recession period, you might see return, but the risk of whatever happening is too high. I'm just thinking.
Yeah. So I mean, first of all, those surveys, they will not ask typically in general about the risk expectations as well. So mostly they focus on the first moment on return expectations. So I could only speculate of, what retail investors would say. Those surveys, they're typically very crude. They don't even ask you about the actual number that you would expect, because probably you would get back some crazy numbers, right? Go to a random person off the street and ask them what they expect equity returns to be over the next 10 years. The distribution that you will get, some reasonable numbers, but some people may say plus 20% or minus 20%, right? So
I'm also just thinking that maybe the reason it's not counter-cyclical is because the risk component is very difficult to kind of ask or put words on or whatever, but it is rational.
It is very difficult to rationalize a low expected return in recession. Even if you would ask the question like, what do you think about risk-adjusted returns, right? So I think what you're asking is, maybe people think of it as not being asked about expected returns, but being asked about risk-adjusted expected returns, and then they say they expect low returns in recessions. But even then, in the data, I think the consensus, it's always going to be some research that says it's otherwise, but I think the consensus is that what we call Sharpe ratios, they're also counter-cyclical. So even risk-adjusted returns, Sharpe ratios, they will be higher in recessions and they will be lower in expansion. So even then, it's going to be difficult to rationalize.
Okay.
At the same time, again, those surveys, they don't ask. It's very that's a general problem with surveys. I think if you ask people on the street, that there may be some misinterpretation of the question, even though you specifically don't ask about risk-adjusted returns, they may think about risk-adjusted returns. There's also a technical distinction between, what we call physical probabilities and risk-neutral probabilities. So, those things matter in academia, and the framing of the questions in such a survey, if you talk to, say, less sophisticated investors, they will matter. I think most of the surveys that we have on retail investors, they actually just ask questions like, do you think the equity market will be higher 12 months from now on a scale from 1 to 5? How much higher? 5, very much higher. 4, a little bit higher. Something like that, right?
Yeah.
And then people aggregate that in some way, make some assumptions, and to get a reasonable data series.
Yeah, but it all makes sense. I'm just trying to come up with a idea of why, if you are in the middle of a recession or whatever, and you get asked, do you think the equity market will be higher or lower?
Yeah.
And despite the rational choice would be higher because it's low. If you are non-finance professional, maybe you just think...
It's very difficult to be counter-cyclical in that, because think about, you're standing there in the financial crisis.
Your job or whatever, right?
You're standing there in a financial crisis, or in March 2020, equity markets have just gone down 20%. Even for institutional investors, it's going to be... They have to have like a set process, like that they're going to rebalance, right? They're actually going to buy equities, right? But if you have experienced those periods, it is just very difficult psychologically to say that I'm going to buy equities now, right?
Yes.
Because the world is burning, the world is falling apart. It's difficult to rebuy equities and have high return expectations. You're just so focused on the last couple of months where prices have gone down, and it's just a natural instinct in some way to extrapolate that and think it will be that way in the future. So I think you really have to have an investment plan, like a process to say that, well, if the prices go down 20%, I really have to rebuy now. It's like, it hurts to some extent, right? But you have to do it,
I agree. Let's move to your paper, Markus, because you wrote the paper called Equity Return Expectations and Portfolios, Evidence from Large Asset Managers, together with Magnus Dahlqvist. What was the motivation behind this?
The motivation was, like I said, that I think most of this research on subjective return expectations, and when I say subjective return expectations, I mostly think about equity return expectations, because that's what we have most of the survey data for, I think. Has focused on retail investors, and at some point you had some representative agent asset pricing model where all investors have extrapolative expectations, and we thought that that is, maybe not how the real world works, and there are some rational investors that actually understands how these relationships that have been found in the data, that high prices actually predict low returns and vice versa. So that was really the motivation to write that particular paper. And the key challenge is just to get data on institutional return expectations, because it's scattered out there on the website. Some institutions in the internet will make them public, but you have to ask them whether they give you a history of the expectations, and it's a little bit of fiddling around and digging into and asking around and to collect this data on institutional return expectations. But yeah, that was really the motivation for writing that paper, that there's been a lot of evidence on. So again, you start out with that rational expectations world of the 1970s, 80s. Then you have a behavioral finance world where, the pendulum swings and people document extrapolative expectations. They have behavioral finance, asset pricing models. And then, the pendulum swings again and say, well, wait a sec, it's a little bit more nuanced. There's also very large institutions that understand the stuff from the 1970s and 80s. Yeah.
Okay. And can tell a bit more about the data you look at and what you actually figure out then in the paper?
Yes, sure. So if you look at these large asset managers, again, think BlackRock, JP Morgan, Vanguard, Fidelity, Franklin Templeton, and so on. Basically, all of them, they will publish something called capital market assumptions. And those capital market assumptions, I would think of those as a set of return expectations and the variance covariance matrix across asset classes. So return expectations on equity, on fixed income, on commodities, and it's going to be much more nuanced than that. So it's going to be like 20, 25 asset classes sometimes. And the variance covariance matrix for all of them. And they will publish that. And I think of it basically as an application of mean variance portfolio theory in practice, right? So what we teach our students, you have expected returns on assets, and you have a variance covariance matrix, and then in the second step, you try to combine those to form an optimal portfolio, and that's a whole different question. How to, it's going to be very sensitive to outliers, and everybody knows that Markowitz portfolio optimization is going to be very sensitive to the inputs that you use. That's a whole different question, how to optimally form your portfolio weights. But in the first step, you come up with the assumptions on expected returns and variance covariance matrix, and that's what they do. And I think they mostly use it to, they're asset managers, right? So their professional job is to manage assets for some clients, right? And they use it to talk to clients and help inform them. And this is how we think about expected returns on different assets. And here's how we do it in our multi-asset portfolios. This is our maybe they will implement it in their target date funds. Maybe they'll implement it in their multi-asset funds, and I think they use it to also go to clients, which could be a pension fund, a sovereign wealth fund, maybe some wealthy private investors, and they say, here are our assumptions. We're gonna overweight this asset class a little bit more because we think expected returns are going to be high because, say, valuations are low, and frame a conversation around that with their clients using these capital market assumptions. Yeah.
Okay. And what do you figure out then when you look at these expectations?
What we figured out, first of all, was we wanted to show that these expectations are actually counter-cyclical, so they're more rational than what you expect from retail investors. So we thought that was just important. It's a super simple result, and it's kind of obvious when you know how they actually form those expectations, which you can talk about in a second. It's kind of obvious once you figure that out. So we thought it was first of all important to document that these expectations, they co-move one-to-one with, say, these object expectations, which you can get from some model, and we use a regression-based model to form what a rational investor should expect, and we use a present value model to generate what a rational investor should expect. And those subjective expectations from the asset managers, institutions, they co-move one-to-one with those rational benchmarks. So we conclude they're rational in the sense that they're counter-cyclical, and they do incorporate this notion that, well, low prices means high returns and high prices means low returns. So that was like a first step, and thought that was important to document. But then we also venture out and we want to see whether they walk the talk. Yes. So do they put their money where their mouth is? Yeah. Do they actually? Is this just marketing material, or is it just for a conversation with the client and nobody believes in it and we actually don't do anything about it, or do you actually put your money where your mouth is? So what we did is that we looked at BlackRock, Vanguard, JP Morgan. They will manage mutual funds, right? And there's databases on mutual funds, and those will contain multi-asset portfolios, so particular allocation funds, balanced portfolios, which invest some part in equities and some part in bonds. So we just check, if you have let's say, in particular, I think we just check if do you have higher return expectations on equities, do you invest more in equities? Do you have lower return expectations in equities? Do you invest less in equities? And you can ask that question both in the time series and also in the cross section, right? So you can say, and in the cross section you can say at a given point in time, fix a point in time, fix June 2026. Does an asset manager that in the cross section has higher return expectations than another asset manager, do they also invest more in equities? And you can ask the question in the time series. You can ask over time for a given asset managers when valuation ratios are high, will they invest less in equities, and vice versa? Yeah. And we found both to be the case. In particular in the cross section, I would say actually. They seem to walk the.
They do walk the talk.
They do walk the talk. Yeah.
Okay.
Not in a way that you would expect from Markowitz portfolio theory. So, if you have a theoretical benchmark in Markowitz portfolio theory, if you change your expected return by 1 percentage point, you go from 5% to 6% by 1 percentage point. That would imply that your portfolio weights, you change them like crazy in some way because it's just so sensitive to the. And obviously, you would not find that in practice. Like, if the expected equity return is 1% higher, they're not going to change the portfolio weight from minus 100% to plus 300%. Like that's just not, so they recognize the limitations they recognize the uncertainty. Even though expected returns are less noisy than realized returns, they recognize the uncertainty around these estimates. It's very difficult to estimate expected returns. We all struggle with it, right? Yeah. It's very difficult. And that shows up in how much these expectations feed through the actions. They're not going to feed through one-to-one. They're not going to feed through according to standard portfolio theory. There's going to be some muted effect. And that muted effect, to some extent, is due to estimation uncertainty in returns. But it is also due to some extent that these balanced funds, they're going to have mandates, right? They're not going to be allowed to have 100% equity weight or 0% equity weight. They're going to be 60-40, 50-50, 70-30. So there's only so much wiggle room in the time series. Once you set that mandate, there's only so much wiggle room that you can wiggle about. Yeah. That's why we thought it was particularly interesting in the cross-section, because you think about that in the cross-section, if you're very bearish on equities, and I think there's one manager in particular in the data that's always very bearish, is a manager called GMO in the US, and they're framed the value investor, and they're very bearish in equities. They forecast equity returns to be minus, let's say 5% over the next 7 years or something, right? So it's like it's a very negative return expectations, and that's their thing, right? That's their thing. They think valuations are permanently too high, and they're going to mean revert back, and that's going to be negative equity returns due to that valuation drag. And
maybe you already alluded a bit to it, but how are these large asset manager expectations formed? What do we know about that?
Yeah, so we know, surprisingly, I think you can infer a lot from the documents that they publish, because they will. So these capital market assumptions, they typically, I would say, published annually. So every year they will come up with new assumptions. But there's often within the document or separate documents are going to be methodology documents. So I think what they're focusing on is to have a coherent set of return expectations across asset classes. So I think what most of them do is they're going to come up with some macro assumptions about GDP growth, inflation, and those are going to feed through different asset class returns. For instance, if you expect high GDP growth, that maps into high earnings growth, and that maps into higher equity returns relative to a manager that would expect lower GDP growth, lower earnings growth, lower equity returns. But it also maps into fixed income. If you expect higher GDP growth, maybe through a Taylor rule, you expect a higher interest rates than a manager that has lower GDP growth expectations. Maybe they expect lower short-term interest rates. I think they will put emphasis on the fact that there's some macro assumptions about GDP growth, inflation, maybe other things, maybe nowadays AI and how that feeds through GDP growth and all that, and build a framework around that, and that will feed through asset classes and make sort of like a coherent picture across asset classes. When it comes to the individual asset classes, they're also going to have a very standard process. So for equities in particular, but also for fixed income, they're going to use something called a building block approach. And the building block approach is basically thinking of equities that by definition you can decompose any equity return into a dividend yield. So that would be a dividend over price plus earnings growth plus a change in the price earnings ratio.
Yeah.
So that's just by definition, but just rewriting the definition of an expected return. You can have, there's no error term in this equation, it's just an accounting identity. You can just mechanically decompose equity returns into a dividend yield, earnings growth, and a change in price earnings ratio. Yeah. And the change in price earnings ratio is sometimes called valuation change or something like that. And basically all managers will think about equity returns through that decomposition. And that decomposition holds exposed, so you can decompose realized returns, what has happened in the past. You can decompose that in those three components. If you were to do that for US equities over the last 10, 15 years, you will see that most of the returns of US equities, maybe except for the last couple of years, have been actually valuation expansion. So just a permanent multiple expansion, permanent higher price earnings ratio. The price earnings ratio, if you look at Shiller's CAPE, Shiller's cyclically adjusted price to earnings ratio, historical average is maybe, 20, something like that. Nowadays it's at 39, 40. During the tech bubble it's 44. So just a trend up in that earnings ratio, right? And that can explain a lot of the realized returns in the past in US equities. But it also holds ex ante. So that's exposed, but it also you can take conditional expectations, it holds ex ante. So what they will do is that they will form expectations about those three separate components. Dividend yield, earnings growth, and change in the price earnings ratio. Multiple expansion or compression. Yeah. They forecast these three separately and then put them together, and that's their equity return expectation. And let's talk about those three components.
Which is, it makes a lot of sense.
It makes a lot of sense because it gives some structure, and in particular you can link those three components to your overall macro assumptions to some extent, because now you have earnings growth in there, and then again you forecast GDP growth. You think that in the long run, GDP growth and earnings growth, they kind of have to be co-integrated to some extent. It can't be that earnings growth in the long run is much higher than GDP growth, because then the firms in the economy would be larger than the economy. So it doesn't work, right? There has to be some alignment between GDP growth and earnings growth. But now through that return decomposition, you have earnings growth in there, so you can have this consistent mapping between GDP growth and earnings growth. The dividend yield, we know from research that the dividend yield basically behaves like a random walk. So the dividend yield behaves like a random walk. So that means that today's dividend yield is a good forecast of the dividend yield 10 years from now. So you have those two components. And then you need to really think a little bit about the multiple expansion. Like, what do you think really? And I think that's the key question everybody has to ask themselves. What do we think is the long run price earnings ratio? Where do you think it will go? If it currently stands at 40, Shiller's CAPE, maybe a 40. Do you think it will remain at 40 over the next 10 years? Is it like a random walk, close to a random walk? Or do you think it will mean revert back to 20, which will be painful for equity investors, right? Because that's going to be a huge drag on returns, right? So that's the key question that you have to ask yourself. And that in turn will depend on your long run growth expectations and your long run interest rate expectations and macro factors.
Yeah, because I don't know how these houses are set up, right? But I guess they get the growth input and the dividend yield input from a lot of analysts. They can like pool together, right? If they, for example, covered all US equities or something, then they could get some numbers they could put together. But that multiple expansion thing, I guess that's where the biggest guesswork comes in, right?
It's tricky. It's tricky. If nobody said forecasting expected returns was easy, right?
No.
I think what some do is they will just have some simple regression models where they regress. They try to find a long run mean by regressing price earnings ratios on GDP growth and inflation in the data and see, well, if you expect higher GDP growth and higher inflation, that will be associated with a higher price earnings ratio in the long run. And based on the GDP growth and inflation assumptions, that is why we forecast a higher price earnings ratio in the long run.
So they try to find some correlation.
Yeah, they try to find some correlation.
There.
Some people also say, like, for instance, AQR, asset manager in the US, they will say, this is too difficult. It's very unreliable to forecast changes in the price earnings ratio. We just assume it follows a random walk. We just assume it follows a random walk, meaning that if it's 40 today, we assume that it's going to be 40 in 10 years and the valuation change will be zero. That component will be zero. And then obviously to some extent you will expect higher returns than, say, GMO that thinks it's going to mean revert to 20.
True, but I would guess that the average large asset manager, don't they expect some return?
Yes. So those are the two outliers, right? Yeah. So those are the two outliers. So I think there's nobody that actually expects it to expand further if it's already 40.
Okay.
There's nobody. It's going to be the most optimistic people are going to have that close to random walk assumption.
Yeah.
And there's going to be very pessimistic people like GMO that think it's going to go back to the level of the 19th century or whatever, right? Go back to 20. And then there's a lot of managers in between that think, okay, we think that valuation ratios are going to be permanently higher than they have been in the past, but still 40 is maybe a little bit too high, so there's a little bit of valuation drag, and it's going to be mean revert maybe to 35 in 10 years.
Okay, but that because I guess that's also where they can put in that counter-cyclical thing into.
Yes,
right?
Exactly, yeah.
So when you look at the data actually in these periods, so I guess the past 10 years, where we have been above Shiller Cape ratio, asset managers have actually added some negative return expectation from multiple compression.
Yeah.
Okay.
And that will produce counter-cyclicality, exactly, because, well, the price earnings ratio prices are high, right? So the price, P over E, price is high.
Yeah.
You think we will revert to some long run average, price go down, that means negative returns.
Yeah. But you said they walk the talk, right? And if they have done this the past 10 years, haven't they been wrong for 10 years then?
Yes, I think yes. I think most, in particular, say GMO, right? They've been wrong for 20 years probably. Yeah.
But also the others on average.
Yes, right? I think on average. I mean, So if you look at the average equity return expectation for the US, right? For the US, they ex ante they expect reasonable numbers. They expect like say 7-8%. Maybe the best one expects 9%. What has been the nominal return realized on US equities over the past 15 years? I don't know the exact number, but I think it must have been 13% per year or something. It's going to be much higher. There's going to be huge forecast errors. They all have underestimated the return on US equities. You will see that for every single asset manager. So then you can draw two conclusions. You think that these asset managers are irrational, right? They all permanently underestimate US equity returns. I don't think that's necessarily true. It's just been an exceptional period for US equities. It's just that the noise term, it's just going to be positive noise surprises to US equities. And
I'm just thinking whether, I guess if you're wrong year after year, if you underscore year after year on your growth expectation, then psychology kick in and you'll be like, at some point,
Yeah.
Okay.
I
thing, and then you turn into momentum and less counter-cyclical. I mean, can you see anything like that?
So they will never get to some extent, maybe. So I think that's an interesting question. We haven't looked at it that in detail actually, but they will always have some sort of mean reversion in the price-earnings ratio. But it could be true that maybe some asset manager says that, well, we expected the price-earnings ratio to go back to an average of 30 or something. But now it's just the US economy is so strong, it's going to be permanently higher growth.
They cannot explain it, basically.
And maybe now we revised, it will go down to 34, but nobody will say that if it's 40 right now, it will be above 40 in 10 years. So they're still going to be counter-cyclical, just through that this valuation drag. And also the first term, to some extent, the dividend yield. The dividend yield is just dividend over price. So if price is high, that means the dividend yield is low. So it's also going to introduce a little bit of counter-cyclicality. So you're not going to get rid of that contrarian return expectations. If you have this process of this building block approach, it's very difficult to get, which is a structured approach, grounded in theory, and it's very difficult to generate extrapolative return expectations with that approach. I think you would really need to have this multiple expansion term, that if you think that price earnings ratios are high at 40 right now, that they're going to be high, even at 44 in the future, right? But you don't see that in the data. Maybe in the future, maybe some will say, well, AI is going to take over. We forecast price earnings ratios of 50 because we think growth is going to be, so high, and that justifies larger price earnings ratios. But I think that's unlikely.
Yeah, but it still sounds like, I mean, if what equities on average long term give 7% return per year, something like that. I mean, when you look at the data, do they, despite they are counter-cyclical to some extent, do they still forecast above like long-term average?
In terms of return expectations?
It's like, do they still think some 9 or I don't know? And then not being actually so counter-cyclical in the end because they still expect a good return from equities.
So we mostly look at equity premium actually.
Okay.
So because we subtract the risk-free rate, and they will be counter-cyclical when you look at equity premium. In whatever way you twist it, but also just looking at the nominal return expectation, they will be counter-cyclical. And I'm just thinking whether I can say something about how many percentage points they will be higher or lower depending on when the price earnings ratio is high or low. I think I have to look at the numbers in my paper, but I think it will be, say you have a return expectation of 9% on average, nominal, maybe if the price earnings ratio is super low, maybe they'll have 11%, and if it's super high, you'll have 7% or something. I should also say that it depends a little bit on so some asset managers, they will give you different forecast horizons. So some will forecast 1 year, some will forecast 3 year, 5 year, 10 year, and some of them will give you all of this. They give you the term structure, they give you 1, 3, 5, 10 years. And then you'll generally see that, let's say you're in a financial crisis, that your 1 year expected return is going to be very high because you assume that mean reversion to happen rather quickly, and it will die out over 10 years. So if you're standing there in 2008, your 1 year expected return is going to be particularly high, and your 10 year expected return is still going to be higher than if valuation ratios were average or high, but it's going to be trumped by that 1 year return.
Okay.
And that building block approach that's applied across asset classes. I think they're going to have a similar approach for fixed income. Your private equity assumptions, they're going to build on your public equity assumptions, and then you have some liquidity premium and all that.
Great. maybe here in the end, Markus, can you sum up your paper?
Yes. So what we do in the paper is we collect data on institutional investors' return expectations from capital market assumptions. We test whether they're contrarian or countercyclical in the time series. And we show that these asset managers, they walk the talk, and these return expectations are reflected in their portfolios. Now, what I would like to emphasize, they're not going to be reflected in the portfolios according to classic theory. They're going to be. Everybody realize that this is a difficult business. There's a lot of estimation uncertainty with estimating expected returns. So maybe the question whether the estimated expected return is 9 or 10% or 7% is not, it's not that important. It matters how you actually map that in the portfolio. And the way I would use these data in practice is that I would say, say if you're a private investor or you're an institution, you're not gonna take these numbers literally because there's so much uncertainty around them. But if there's 20 asset managers and all of them expect higher returns on emerging markets and lower returns in US equities, then you can look at your benchmark portfolio. Say your pension fund, you have a market cap weighted benchmark, and market cap US equities is maybe 65% now in the all country world index. And then you can say, well, every one of those asset managers, institutions, they expect lower returns in US equities than in the past, and then say emerging markets or Europe. So I'm going to weight that down a little bit. I'm going to go from 65% market cap weight in US equities to maybe 60% or 55%. And that's going to depend on in the black middleman world, it would depend on how much you want to shrink away from the benchmark. But again, nobody's going to take those numbers at face value. You have to use them in that way. Everybody expects US equities to earn lower returns, so we're going to adjust the equity weight on US equities a little bit down. Everyone expects high fixed income returns because yields are now high. Maybe we think about adding a little bit to our fixed income allocation. I think that's looking at the consensus and disagreement in the cross-section across asset managers. I think that could be valuable in the real world, yeah.
Interesting. And I guess maybe last thing, if institutions do this, so weight US equities a little bit down and have been doing so, I guess, the past 10 years, then the ones buying additional US equities must be retail investors. Isn't that the implied conclusion?
Somebody must be buying. Yes, somebody must be buying. I think, in the end, these institutions, they just manage other people's money, right? So they just they might be buying as well if they just get more inflows, right? But the inflows must come from somewhere. They don't come from aliens, right? So it must be, in the end, households, people own the wealth in the economy. Like, it belongs to us, right? It doesn't. So there have been inflows in US equities that will increase inflows in funds, inflows in mutual funds that will increase the assets of these asset managers. They're huge now. BlackRock over 10 trillion, Vanguard over 10 trillion, and they will have bought equities because of those inflows. Maybe they've bought less than they otherwise would have if valuations were lower. Right? But they will be a net buyer of US equities over the last 10 years, even though they have countercyclical return expectations, just because they have gained so much assets, I think. Yeah.
Makes sense. Yeah. Thank you so much for participating, Markus.
Yeah, great conversation. Thank you.
Tak for, at du lyttede med til Rig på Viden. Jeg håber, at du lærte noget, og hvis du nu synes godt af vores podcast, så kan du støtte os ved at følge den på Spotify eller skrive en anbefaling på iTunes. Inde på LinkedIn, der kan du følge André Thormand, Benjamin Somofen eller Henrik Fode Rasmussen. På genhør.